Asset classes. There are different asset classes when you think of investing. An asset class is a group of investments that behave in a similar way, have similar features, and follow similar laws and regulations. The most popular asset classes are equities, bonds, cash, and commodities. Some uncommon asset classes, which are called alternative assets, include real estate, art, and stamps. Let's run through them in this capsule. Equities are also called as stocks. When an investor buys a stock in a company, he becomes an owner of a part of the company. The more stocks you buy in the company, the greater is your ownership of that company. Stocks can be either bought or sold on the stock market. If you sell a stock, you give your ownership of the company to the buyer of the stock. A company issues bonds to the public when it wants to borrow debt from the public. This works exactly the same way a loan does. If an investor wishes to lend money to the company, he will buy their bonds. In return, the company will pay interest to the investors in installments and will pay back the loan amount at the expiry of the bond. Stock markets are riskier than bond markets because stock prices fluctuate more than bond prices. The risk is compensated by higher returns in the stock market than bond markets. Bonds pay you a fixed interest every 6 months, whereas stocks pay you dividend depending on when the company wants to give it.
Real estate asset class involves investing in land or property. The commodities asset class involves investing in precious metals such as gold and silver. You can also invest in alternative investments which include arts as well as postage stamps.